Okay, what is going on, guys? Welcome to Stock Talk with Nico Kritikos. Today, we're going to be doing some stock analysis for Lemonade stock because this stock is up 34% today after they reported earnings, over 230% just in the last year. And I'm kind of disappointed because I've been watching this stock for a very long time. Years ago, I was watching the stock, but specifically the last 2 to 3 weeks, I've been keeping an eye on this and I said, okay, I kind of want to buy this, but I don't think it's a good time because, okay, let's say I was going to buy this in what, the $50, $60 range. I said, all right, well, the stock is already up, 200% this year. I don't think I'm going to buy it. But I wish I did now because that would have been a good idea. At the same time, the valuation is actually looking kind of rich, which we're going to get into that. But really, like if we look at the price to sales here, and this is probably not even counting today's move, but the price to sales is a 6.4. It's probably only over 7 now. So I mean, you compare that to the past year when the stock was, $30, it would have been a much better deal because now we are paying, 7 times sales or whatever. Let's go over here to Qualtrim. Price to sales of 8.8. Okay. So yeah, I think this is probably, I mean, who knows? Nowadays, these stocks like Palantir and stuff can just run up to ridiculous valuations. So who knows? Maybe Lemonade will be $100. But my point is the valuation is high and I wouldn't want to pay anywhere near this price. So let's get into why the stock shot up. All right, third quarter 2025. Lemonade reported revenue of $194 million, which was a 42% increase year over year. Wow. EPS was only negative 51 cents, better than the forecasted negative 70 cents. Okay, so that's good. Again, 42%, that's huge. And actually, real quick, why don't we look at what they're expected to do next year? Because the revenue growth is incredible for this company. We have 36% expected, which I think they just beat that. 60% expected for next year. So it's crazy. Guidance was raised, I believe, increased to 727 to 732 million, which was previously 710 to 716. So they upped their guidance. Okay. They adjusted the EBITDA loss is now narrowed down just a little bit. This is a fantastic metric. 24% year over year increase for number of customers, 2.8 million. That's pretty strong. They're growing fast. Gross profit increased 113% and gross margin is 41%. Okay. Let's see what happens if I click on this. I haven't used this AI one. I use mostly the chat, which I do want to get into. Yeah, we're going to look at what chat has to say real quick. So I asked chat, how are they going to make a profit, right? Because their model is a little bit different. And this is interesting. Lemonade takes a fixed portion, about 25% of every premium up front. So then the other 75% goes into a pool for claims, reinsurance, and charitable givebacks, which is interesting. So the way they profit is a little bit different, and you can choose which charity you want to give your money to. Okay. Now they also I think you can also get some of that money back too. It's kind of weird, I probably could do a little bit more research on this, but that's the general idea. Because Lemonade runs, this is also important. Because they run through AI and automation, they don't have the large payroll and agent commissions that traditional insurers do. That's a good thing. This keeps overhead low and allows them to scale quickly. Okay, fantastic. They buy reinsurance, which means if there's a huge disaster, the reinsurer covers those payouts. Okay, that keeps Lemonade's risk and volatility, blah blah blah. That's it. Okay. So look at their numbers. EPS is expected to be negative 242, then negative 1.6. So it's probably going to be a couple years till we see this stock become profitable. Okay. As for their revenue growth, though, look how nice this is. They have gone from 128 million 4 years ago to now 600 million. Okay. Incredible. Net incomes, it's not great. It's staggering along there, but hopefully one day they're going to be profitable. Free cash flow, they've gotten a lot better with free cash flow. The cash to debt ratio is okay. All right, it was better a couple years ago, so they're obviously investing in stuff. But it's still it's not like, at least they're not in a bunch of debt. A lot of some companies out there have 10 times more debt than cash. Shares outstanding. This is also not this is, I don't want to make this sound like a bad thing right now because this is understandable for their position, but technically it is not helping the stock price. So there is that. But I mean, I from the beginning, I've loved this business model. Okay. I've always wanted to own this stock and I never bought it, but maybe one day I'll buy it, but the valuation has to be cheaper. Okay, that's kind of the way I see it. If this stock went back down to, maybe like the 30 to $40 range, it would be interesting. At this price, I don't see it. Now, the other thing I was thinking about was it's nice that I guess it's a good thing that their income's going to be more stable. You can look at it from that perspective, but the bad thing is, I mean, if they're not aiming for, high profits or they're, you know what I mean? Like they're giving the money away to charity, and that's great that they have this fixed fee they're going to take, but so that means they're pretty much they're only growing the sale profit's only going to grow if with more customers that get on the plan. But I mean, of course, I do like the idea that hey, there's a stuff is automated in the business that makes things faster, more efficient, makes it cheaper. You don't need as many employees. You could probably offer lower rates, all this stuff, right? So that's the good thing. But I don't know about this monthly, where they just take a flat fee. So I mean, it could work. I guess they could just keep getting more and more users. It's possible. I don't know. Let me know what you guys think down below, and I will see you in the next video.